Making smart financial decisions isn't reserved for experts. Everyone can benefit from using their financial knowledge. Whether it's managing everyday expenses or planning for the future, effective money management involves aligning your finances with personal goals. Welcome back to the Finance Homefront with me, Bev. And this video covers essential topics such as balancing school, work, and finances, understanding the traits of financially healthy students, exploring average college student debt, including credit card debt, and delving into the reasons people find themselves in unplanned debt. Before we move forward, I'd like to take a moment to appreciate everyone who's supporting our channel. And if you haven't yet, please like, subscribe, and ring the notification bell so you can be part of our growing community. And without further ado, let's talk about financial literacy. Comparable to staying physically fit, achieving financial health doesn't require a magic formula, but demands putting your financial knowledge into practice, especially when tempted to indulge. Becoming a financially healthy student shares this similarity. It requires a few key insights. Although the challenge lies in making informed decisions daily, the immediate benefits, like having extra cash, are worth it. For students, financial health goes beyond earning more than spending. It involves managing the unique trade-off between studying and working, often necessitating taking on educational debt. A financially healthy student minimizes educational debt while pursuing career goals, making wise choices about loans, and understanding the balance between spending and repaying. To maintain financial health as a student, track your income, monthly bills, and daily expenses. Understand bank fees, check your credit report, and create a plan to minimize expensive debt by considering long-term goals and career plans. Students often face high levels of debt, with an average student loan debt exceeding $30,000 and additional credit card debt around $4,000. Unexpected expenses, job losses, and tuition payments contribute to financial challenges. Peer pressure and marketing efforts can make managing spending difficult, emphasizing the need for careful consideration of everyday expenses to avoid substantial debt over time. To achieve your financial goals, start with a practical budget. A budget is essentially a spending plan based on your income and expenses, helping you stay on track day to day and month to month. While most students deal with debt, like federal student loans, a budget won't eliminate all debt, but minimizes unnecessary expenses and builds healthy financial habits. Investing in tuition is worthwhile, leading to higher wages and better job opportunities post-graduation. However, unplanned expenses, like frequent dinners out, can add up quickly. For instance, two $20 dinners a week over 4 years could cost $8,320, potentially financed by credit cards, resulting in hefty payments post-graduation. Many graduates regret accruing credit card debt, emphasizing the importance of mindful spending. Budgeting is simple. Ensure your income exceeds expenses using budget calculators. Estimate monthly incomes from jobs, loans, scholarships, or savings, and calculate expenses like food, lodging, and bills. Be realistic and adjust if needed. Tracking spending for a week or month helps create a budget, preventing lasting credit card debt. Compare your planned budget with actual spending, keeping receipts and categorizing expenses. College students facing financial stress can consult their school's aid office, and part-time students with full-time jobs can consider setting up an emergency fund for unexpected expenses. Remember, budgeting is trial and error, so adjust as needed for financial goals. Selecting the right bank or credit union is crucial for students, and the choice made when opening an account years ago may not be the best one now. Consider exploring credit unions, which are often nonprofit organizations providing competitive financial services compared to major banks. Check if your school is associated with a credit union or if there's one in your local area. Additionally, prioritize convenience by opting for a bank or credit union with branches near your home or school, and ensure there are accessible ATMs to avoid fees that can amount to $2 or more per withdrawal. Keep an eye on low or no fees, as monthly checking account fees can add up to $180 per year. Be cautious about free accounts that may have transaction limits, leading to per-transaction fees if exceeded. Online account management is essential, so choose institutions with robust online services for easy money management. Online banking not only saves time and paper, but also provides features like bill payment, reminders, and downloadable transaction records for financial software. Building a long-term relationship with a financial institution is vital, so explore your options. If you find yourself facing excessive fees, a simple inquiry about better account options could save you significant money during your time in school. Students commonly use two types of financial accounts: checking and savings. Checking accounts. These act as the financial hub, where income flows in and expenses flow out. It's recommended to keep only 1 month's expenses in your account and use a linked savings account for extra cash. To minimize checking account costs, consider factors like service charges, interest-bearing accounts, direct deposit, and automatic transfers. Choose a student checking account with no fees, but be mindful of transaction limits. Savings account. Often used as a safe place for cash gifts, savings accounts offer interest without the risk of increased checking account fees. They can be a powerful tool for budget management. Consider features like automated monthly transfers, avoiding penalty fees, avoiding monthly fees by linking accounts, and automatic savings. Money market accounts and certificates of deposits, or CDs, are additional options for those with substantial sums, each with its own advantages and considerations. Money market accounts offer higher interest rates, but may require a minimum balance. CDs pay comparable interest with lower investment requirements, but tie up with your money for a specific period, with penalties for early withdrawal. Understand the terms and penalties before committing to a CD. Credit and debit cards may seem alike, but they work differently. With a credit card, you spend borrowed money and can carry a balance, but be cautious about interest and fees. Debit cards take money directly from your account, promoting responsible spending. Watch out for courtesy overdraft protection fees. Debit cards are good for daily budgets, while credit cards offer fraud protection and solutions for issues. Use a debit card for everyday purchases and a credit card for online shopping, paying the balance to avoid interest. And speaking of credit, it's a ubiquitous aspect of daily life, facilitating transactions from small purchases to major investments. At its core, credit represents a commitment to repay a loan under agreed terms. Credit worthiness is assessed through credit reports and credit scores, with the former providing a comprehensive financial history and the latter condensing this information into a 3-digit number, typically ranging from 300 to 850. Credit reports, generated by major bureaus like Experian, Equifax, and TransUnion, detail personal and financial data, influencing loan approval and interest rates. Errors or negative entries can have far-reaching consequences, affecting not only loans, but also opportunities with employers, insurers, landlords, and more. It's advisable to review your credit reports annually, as discrepancies can be rectified under the Fair Credit Reporting Act. Credit scores, encapsulating your creditworthiness, are pivotal in loan approval and interest rate determination. Key factors influencing your score include payment history, credit utilization, length of credit history, new credit accounts, and credit mix. The higher the credit score, the better the financial standing. While obtaining credit reports is mandated through annualcreditreport.com, checking credit scores may require various methods, such as purchasing directly from credit reporting agencies, utilizing free online platforms like Credit Karma, or accessing scores assessed by credit card providers. Maintaining and building a positive credit history is paramount for securing favorable loan terms. While some platforms offer free credit scores, be cautious of scams and thoroughly research any paid services before opting in. Regular monitoring of both credit reports and scores ensures a proactive approach to maintaining financial health. Effective account management involves strategic approaches for checking and savings. For checking accounts, minimizing fees, setting up direct deposits, and being mindful of overdraft protection options are key. Savings accounts can benefit from automated monthly transfers, avoiding penalty fees and capitalizing on automatic savings plans. Students with credit cards face unique challenges, such as avoiding courtesy overdraft protection, understanding fraud protection, and utilizing credit responsibly. Maintaining and improving credit scores involves regular review of credit reports, prompt error resolution, and strategic actions like on-time bill payments and credit utilization management. Understanding identity theft and preventing it requires vigilance in monitoring accounts, securing personal information, and leveraging tools like credit freezes. Identifying warning signs of excessive debt involves tracking spending, managing credit card balances, and seeking financial guidance if debt becomes unmanageable. Overall, a proactive and informed approach is crucial for sound financial health. Individual outcomes may vary, so consult professionals and do your research before big decisions. If you enjoyed today's Finance Homefront episode, show some love. Like, subscribe, and hit the notification bell for more financial tips. Your support keeps us going. Stay tuned for more valuable insights, and remember, a financially savvy future starts with being informed. See you in the next video.